In less than 24 hours, the silver market faces a structural event that Wall Street is simply not prepared for. Now, let's be clear from the start. This isn't hype, and we're certainly not making any price predictions. Instead, what we're witnessing is a mechanical market event, a rare convergence of factors poised to create significant pressure. We're talking about a gamma squeeze, a term many misunderstand, often conflating it with other market phenomena. But the consequence here is profound. If this event triggers as it appears it might, price won't be the primary concern. Availability will be. So why now? What has shifted dramatically this week to bring us to this precipice? The answer lies in some truly unusual options, positioning within the silver market. We've seen a massive concentration of call options stacking up just above the current spot price. This is crucial because it creates a distinct vulnerability. The timing couldn't be more critical. We have this significant options expiration coinciding with notoriously low liquidity in the market, a combination that brews instability. It's vital to stress that this particular setup, this confluence of options activity and market conditions, simply did not exist even a month ago. And here's the line to really hold on to. This only works when physical supply is thin, and it is. Let's break down the gamma squeeze in plain language, stripping away the jargon. At its core, it's about market makers. These are the entities who sell options to traders. To manage their risk, they must hedge their positions. As the price of the underlying asset, in this case silver, begins to approach those options strike levels, market makers are forced to hedge by buying the underlying asset. Here's the key insight. This rising price then forces more buying, which in turn forces even more rising prices. It becomes a self-reinforcing loop. This process is entirely mechanical, driven by algorithms and risk management protocols, not by emotion or speculation. Crucially, it contrasts sharply with a short squeeze. While both can be dramatic, a gamma squeeze is typically faster and far more violent in its execution. Now, why is silver uniquely susceptible to this kind of event? Several factors make it particularly vulnerable. First, consider silver's inherently thin liquidity compared to major equities or even other commodities. There simply isn't as much trading volume to absorb large moves. Compounding this is the high paper leverage in the silver market relative to its tiny physical base. This means a small shift in paper markets can have an outsized impact on the physical. We've also seen registered inventories already under significant stress, indicating a tight supply. Furthermore, industrial demand for silver is notoriously inelastic. It doesn't just back off during volatility. This means buyers with essential needs will continue to purchase regardless of price spikes. The line to hammer home here is clear. Silver doesn't have the depth to absorb forced buying. Let's zero in on this specific trigger. Monday. We're looking at a critical window. The catalyst is the options expiration, combined with the traditional liquidity gap that often occurs at the market open. This is when dealers will make their final hedging adjustments. Weekends play a significant role here. With no trading, there's no release valve for the building tension, allowing pressure to accumulate. This is why we often see significant moves right at the market open. While we won't give exact numbers to avoid predictions, know this. If price clears a certain zone, the cascade begins. Watch that opening bell closely. It's important to dispel a common misconception. This is not a phenomenon driven by retail traders on forums like Wall Street Bets. This isn't YouTube hype. This is fundamentally about institutional dealer positioning and the algorithmic responses programmed into their systems. These institutions are reacting to risk parameters, not personal beliefs or market sentiment. The industry doesn't wait for price confirmation. They preempt it through their hedging strategies. This is a game of risk management, not speculation by the masses. If this squeeze accelerates as expected, we face a critical question. What breaks first? Price or promises? We could see paper liquidity evaporate almost instantly. Bid-ask spreads, the difference between what buyers are willing to pay and sellers are willing to accept, could widen dramatically. More alarming, available silver in the physical market could simply disappear as demand outstrips readily supplied metal. This could lead to prices gapping violently or even disconnecting entirely from the physical market. This scenario also introduces the very real risk of exchange intervention. But as history shows, they don't stop squeezes by delivering metal. Historically, we've seen a suppression playbook deployed in these situations. Tactics include massive paper dumps designed to flood the market and drive prices down, or engineered volatility spikes to shake out weaker hands. We've also witnessed hikes in margin requirements, making it more expensive to hold positions, forcing liquidations. However, there's a strong argument why these tools may not work this time. Physical demand, unlike speculative paper demand, doesn't liquidate easily. And critically, the hedging requirements for market makers are mandatory. They must buy the underlying. This creates a standoff where traditional suppression tactics might find their limits. So what is smart money, the experienced market participants, watching for? They'll be scrutinizing volatility skew, which indicates the market's perception of future price movements. Dealer gamma exposure will be a key metric, revealing how much hedging activity is still required. The premium of physical silver versus futures prices will be a critical divergence to observe. And finally, inventory movements after the market open will confirm the real-time demand and supply dynamics. Remember this, the real signal comes after the first hour. Don't jump to conclusions too quickly. Now, a crucial disclaimer, this is absolutely not financial advice. Our goal here is to foster awareness, not to dictate action. It's about understanding the mechanisms at play and recognizing counterparty risk. There's a significant difference between owning physical metal and simply owning exposure through paper assets. In a situation like a gamma squeeze, speed matters and paper contracts are inherently slower than physical possession. The key line to remember is, in a gamma squeeze, speed matters and paper is slow. Let's reiterate the urgency. We are now in the final 24 hours. This isn't just another market event, it's a structural stress test for the silver market. The outcome isn't guaranteed, but the immense pressure building is undeniable. As we head into Monday, be prepared, because if silver gaps at the open, it won't ask for permission. Watch the open.